Ms. Tenney is recognized for 5 minutes.
Thank you, Mr. Chairman, and I just want to thank the excellent panel for being here today. This was very helpful and very enlightening. I just want to highlight a few things. Over the last 10 years, the community financial institution industry has undergone dramatic transformation, as you've heard. Since 2006, more than 1,500 banks have failed, been acquired, or merged due to economic factors and the overwhelming expensive regulation brought forth by the passage of Dodd-Frank. During that same period, there's been a drought in de novo banks, or new banks. In fact, only 5 new bank charters and 60 new credit unions charters have been granted. Today, for the first time in over 125 years, there are fewer than 6,000 banks and roughly 6,000 credit unions serving the consumers in the United States. This is proof that a community financial institution needs smart, common sense regulatory relief so they can properly serve local communities by assisting with small business startup and consumer credit. I'm working on a bill called the Community Institution Mortgage Relief Act that would offer real relief for small institutions that are barely staying alive in this regulatory environment we currently have. This bill would exempt small community institutions from mandatory escrow requirements and would provide relief from new regulations that has approximately doubled over the cost of servicing, with a direct impact on the consumer cost of mortgage credit. I know that certain institutions wish to provide escrow services to their customers, and they are welcome to do so under this act. This is about autonomy and the choice for smaller institutions. However, for the smaller institutions, like the ones in my district, they rely on relationship banking, something that has seemed to disappeared in this day and age, and this could help them greatly. I first wanted to address this with Mr. Tuggle, since he so kindly addressed positively my proposed regulation, or my proposed bill to minimize regulations, actually. And you referenced in your testimony that you supported the bill, but that you would have some suggestions in regulatory changes, how we could make this bill more effective or better. And if you could highlight those, I'd appreciate that.
Thank you. It's fairly simple. I think that what you want to do is if I understand the bill, I believe I do, one of the exemptions is tied back to the $50 billion number, okay. And I just have a problem with that as an arbitrary number that doesn't reflect reality. Let me say, our company, we're $30 billion. We had a large mortgage business we sold in 2008 and basically got out of the business. At $30 billion, we don't provide escrow services today. And it's in part because of the expense of it relative to the fairly lower number of mortgage loans that we make. So I don't know that $50 billion is necessarily...
Let me ask you, what would you use as a determining factor? If not an arbitrary number like $50 billion, what would you say in looking at it in a regulatory framework? How would I change the law to amend it to make it more flexible? So we really address a lot of the community banks who are looking for flexibility, who have suffered under a lot of the regulations, who can't comply, who want to continue their character lending or their relationships with their customers, who they see usually on a daily basis, especially in small areas like rural areas that comprise most of my district.
I would think that I think there's another proposal, number of loans. The number of loans like this that are made would make a lot of sense, because that proves that this is a small lender that shouldn't be suffering these expenses. And I completely agree, and I think what you said goes across a lot of different areas, and that is, you know, when you put a lot of expense on a small lender or a product or a small loan, you make it less accessible to people. There's less of it, and I would think that what we should be about are laws and regulations that expand the availability of credit. And these small servicers, I think you said it correctly, know their customers, know who they're dealing with, and have the ability to take care of.
Yeah, we did propose on the news, as you indicated in the second half, on the RESPA, the Real Estate Settlement Procurement Act, or whatever that is. I've done thousands of real estate closings, and I just call it the RESPA statement, which is probably filed somewhere and nobody ever sees it again. But I wanted to, so we had a limit on there of changing that to banks that do 30,000 or less loans. Do you think that's something that would be acceptable?
I'm not an expert in these smaller
Okay.
lenders, but it sounds reasonable to me. I would also add that perhaps there would be the opportunity to craft a little broader legislation and to give some opportunity for regulators to address problems and with direction to make credit more accessible.
Thank you. I appreciate that, and I think my time has expired. I yield back.